right, I'm very pleased to be here. I think this is a very important conference. Certainly the jobs crisis is something which is not given enough attention, I think, by a lot of academics on both sides of the Atlantic and by a lot of, oops, giving away the punchline already. How'd that happen? Uh-oh. The jobs crisis is something which doesn't get the attention it deserves. Actually, just last night I checked into the hotel and I turned on CNN News, and there was a major news story, which is that the recession in Spain is over. Because, I'm not kidding, this was last night on the news. Growth in Spain last quarter was positive 0.1%. So the recession is over. The announcer actually expressed some puzzlement that there wasn't a massive stock market rally at this. Dear, what is happening? Wasn't a massive stock market rally. The announcer mentioned somewhere along the lines that unemployment is still stuck at 27%, but that was considered a relatively minor blemish on this exciting story that the recession is in. So I'm going to address, I think, a fairly straightforward question, which I put in plain English. The question is, if there's a recession and unemployment rises, is it likely to return back down to its previous level in a few years, or is it likely to stay for high for a long time? So if you want to use the appropriate jargon, this is the question of does unemployment exhibit hysteresis? It's a matter of taste. I personally think the term hysteresis sounds more complicated than it really is. So I like to just think of it as a very pragmatic question of if unemployment goes up, does it stay high or does it come back down? And the answer I'm going to give is that sometimes it comes back down, sometimes it doesn't. More often than not, though, when we see a recession push unemployment up, it tends to stay high for a very long time. And that's a very simple fact, but one I think worth stressing because it's inconsistent with mainstream economics. If we describe mainstream economics as what's in undergraduate textbooks in the U.S. and what I indoctrinate hundreds of undergraduates with every year, the textbook models say that there's a natural rate of unemployment and that if a recession pushes unemployment up, within a relatively short cyclical period, unemployment will come back down to the natural rate. And I think it's very important just to see empirically that that's not true. That recessions often have very long-lasting effects on unemployment. I think this is in keeping with the spirit of the research program behind this conference. I was reading some of the materials in the conference packet, which talk about the long-run effects of monetary policy and also the role of exchange rate regimes that I'll mention in particular. So I'm hoping this goes over better than when I present similar material at the European Central Bank, because there people very much believe in the long-run neutrality of monetary policy. Okay. Now, so I'm going to give an overview of some evidence on this basic fact that increases in unemployment are often very persistent. I also will talk about why in some cases increases in unemployment are not persistent and unemployment goes back down. And I think generally that can be explained by monetary policy. That if unemployment goes up, it's quite capable of going back down if monetary policy is sufficiently expansionary, but not if monetary policy is passive. And again, I'll give some general evidence, and assuming I have time at the end, I'll talk about some research in progress on one specific aspect of this issue, which is the role of exchange rate regimes and what happens when there is capital flight and exchange rates are either fixed or flexible, and how that affects the persistence of changes in unemployment. All right, well, let me get into the details. So again, the basic question I'm interested in is very simple. If there's a recession that pushes unemployment up, does unemployment come back down the way textbooks say it's supposed to? This is I picked Sweden. This is one of my favorite examples just because it's so clear cut. Sweden, as we know, had a financial crisis in the early 1990s, and that caused a big spike in unemployment. But it's now more than 20 years later, and I believe that whatever problems there were in the banking system in Sweden have been sorted out. But nonetheless, the fact that there was this crisis more than 20 years ago has left essentially a permanent legacy of high unemployment. Again, not what you would think if you read leading macro textbooks, but that seems to be the way the world works, at least in Sweden. Also next door in Finland, that's basically the same story. Now, Sweden and Finland in the early 90s had big financial crises. And one currently popular idea is that there's something special about financial crises and that financial crises have very long-lived effects. So Reinhardt and Rogoff and various IMF studies have argued that recessions caused by financial crises have very long-lived effects. I think that statement, recessions caused by financial crises have long-lived effects, is true but somewhat misleading because I think just about all or most recessions of any sort have very long-lived effects. So the fact that a recession is, whether a recession is caused by a financial crisis or by something else, it's likely to raise unemployment for a long time. Now, practically speaking, going back over the last several decades, looking at advanced economies, emerging markets, there have been two primary causes of recessions. One is various kinds of financial or banking crises. The other is monetary tightenings aimed at reducing inflation. In my opinion, either of these two types of demand-driven recessions, financial crises or disinflations, either one can easily lead to a very long-lived increase in unemployment. Now, this is another favorite example of mine, somewhat far geographically from where we are right now, Colombia, but you know, a very nice picture. So if you know anything about Colombia, in the early 1990s, they became dissatisfied with their inflation rate, which was around 25 or 30%, and over a period of a decade or two, tightened monetary policy and steadily pushed inflation down so that now they have a 3% inflation target. But this long, steady reduction of inflation caused by tight monetary policy brought with it a long, sustained, essentially permanent increase in unemployment. And again, there wasn't any financial crisis in particular. It was just a slowdown, a persistent slowdown in the economy caused by a monetary tightening. Now, quite a bit, this picture is a little bit less dramatic, but quite a bit closer to Germany, is France. So France, like many European countries and the United States for that matter, had high inflation in the 1970s, and in the early 1980s had a monetary tightening aimed at reducing inflation. And that started right around 1980 in France. And what you're supposed to focus on in this picture is that when policy tightened in France around 1980 to raise unemployment, unemployment was initially a little bit above 6%, and it rose above 10%, and 15 or 20 years later, in the late 1990s, unemployment was still well above 10%. It's come down a little bit since then, but we still, as of today, have not gotten all the way back down to the level before the monetary tightening of 1980. So again, suggesting that contractionary monetary policy can have very long-lived effects on unemployment. All right, now I've chosen some examples where it's pretty clear that when there was a recession and unemployment rose, that there seems to be a hysteresis effect, that unemployment stays high or continues rising for a long time. Now, that's not always the case. If one looks around at different historical episodes, there are also some examples of countries where unemployment went up and then came right back down, again, obeying what macroeconomics textbooks say is supposed to happen. So again, not exactly a European country, but one of my favorite examples, Korea in the East Asian financial crisis had a big recession and a very sharp rise in unemployment. But then after 2 or 3 years, unemployment went right back down to the level before the financial crisis. So there's no evidence of hysteresis here. The recession had only very transitory effects on unemployment. In the United States, and here let me just concentrate on the first part of this sample. I'll come back later to the recent financial crisis. But if you look at the US in the 1980s, that's also a textbook case of the Volcker monetary tightening, which reduced inflation, pushing unemployment up very quickly, but then unemployment coming right back down. So again, in the 1980s in the US, in contrast to a number of European countries, no evidence of hysteresis or no evidence of long-term effects on unemployment of the monetary tightening and disinflation. Okay, so the way I would read the history of different countries is, again, try to put it as simply as I can. When there's a recession and unemployment goes up, often it stays high. Sometimes it comes down rather quickly. What might explain why unemployment sometimes stays high after recessions, sometimes comes back down? In my opinion, the dominant factor is the response to the recession of monetary policy. And if we go back through the examples that I've given, where unemployment either did or did not come back down after a recession, I think that corresponds quite well to whether or not there was expansionary monetary policy aimed at reducing unemployment. So if you know the history of the US, Paul Volcker in the early 80s tightened policy very sharply to reduce inflation. But once inflation started falling and there was a recession, the Fed actually shifted course very sharply and had very expansionary. So Ronald Reagan, in running for re-election in 1984, talked about morning in America, that he'd restored moral values to America or whatever. But I think a different interpretation is that the Fed had very expansionary policy so that unemployment fell very rapidly. The economy recovered very strongly in 1983, 84. So unemployment came down, as we saw in the picture of the US. In the case of Korea, as you probably know, Korea had an exchange rate peg, but when they had massive capital flight in the East Asian crisis and that caused an increase in unemployment, they were quick to allow their exchange rate peg to collapse, which was a good thing because it amounted to a monetary expansion which pushed unemployment back down. In contrast, I gave the examples of France and Finland. There, I think, those were both before the euro, but when France and Finland were part of the European monetary system with rather rigid exchange rate pegs. And long story short, I think that perhaps policymakers in France and Finland might have liked to have done something to offset the recessions in those countries, but they were constrained by the need to maintain relatively fixed exchange rates. So policy was not very expansionary. And then again, I had the picture of Colombia, where we simply had a monetary tightening that lasted for 15 or 20 years as they ground inflation slowly out of the system. So when unemployment went up, rather than responding with expansionary policy, they kept policy very tight for more than a decade because they wanted that they had such a strong desire to reduce inflation. Okay, so I find it informative to look at different historical episodes. So far, I've chosen ones that illustrate my points as simply as possible. Things are somewhat more complex, Actually, this is not that complex. In Argentina, Argentina is one of my favorite examples, again, of the very basic point that the monetary regime that's chosen can have very long-lasting, large effects on unemployment. So the currency board was introduced in Argentina in the early 1990s. That led to a large increase in unemployment. And unemployment kept going up and up and up as long as the currency board lasted. And then when the currency board collapsed, and in effect policy shifted in a very expansionary direction, then we got a massive decrease in unemployment. All right, now the UK is actually quite complex, and maybe some people who know more about the UK than I do can give their views at some point. But here's my reading, that the history of monetary policy and unemployment in the UK has been somewhat erratic. So those of you who know the literature, the famous Blanchard and Summers paper on hysteresis was motivated by the experience of the UK in the 1980s. That under Margaret Thatcher, monetary policy was tightened to fight inflation. There was very contractionary monetary policy, and as of the late 1980s, when Blanchard and Summers were popularizing the idea of hysteresis, it looked like unemployment had risen very persistently in the UK. Now, it turned out that that was actually reversed quite sharply in what I believe people in the UK call the Lawson boom, which, as far as I can tell, was essentially an accidental overexpansion of the economy involving fiscal policy. I mean, for me, the key figure is that the inflation rate went from 3% to 7%, which I don't think was an intentional policy. I think demand got stronger than policymakers wanted, but the very strong economy did have the effect of reversing the increase in unemployment that occurred as a result of the Thatcher disinflation. Around 1990, with high unemployment, policy turned contractionary again, and that pushed unemployment up. But again, what finally was, as in Argentina, although there are lots of differences between the UK and Argentina, the common factor is what really resolved the unemployment problem was the end of the attempt to peg the currency. So when the UK dropped out of the European monetary system, that was a fundamental shift in monetary policy, which set the stage for a prolonged decrease in unemployment. Now, in the United States, again, I've already talked about the early 1980s when there was a short-lived increase in unemployment because the Fed responded aggressively to the rise in unemployment. In the Great Recession of the last few years, the unemployment rate rose, and I guess if I updated the figure, it's come back down a little bit more, but the unemployment rate's still above 7%, and it's going to be a very long time, I think, before we see the 5% level of unemployment that was considered normal and non-inflationary just a few years ago in the United States. Now, here, I think the fundamental problem is the zero bound on interest rates. I think my overall point is that if you see unemployment rise in a recession and then it does not go back down, that's because for some reason monetary policy has not been sufficiently expansionary in the face of the rise in unemployment. And there can be different reasons why monetary policy is not expansionary. It can be an overzealous fight against inflation, as in Colombia or as in Margaret Thatcher's United Kingdom. It could be an overly restrictive exchange rate regime. Or in the case of the United States, it can be the zero bound. So people who calibrate Taylor rules for the United States find that the Taylor rule says that the federal funds rate in the U.S. Should have been negative 5% in 2009. So by that measure, if you didn't know about the zero bound on interest rates, you'd think the Fed had lost their mind and was keeping interest rates 500 basis points above the optimal level, and of course that would keep unemployment high. we understand why there's a zero bound, but what it amounts to is an impossibility of having enough monetary stimulus to push unemployment back down to the level before the Great Recession. Japan is also actually like a straightforward case where the constraint is the zero bound on interest rates, that when a recession, deep recession occurred in the 1990s, the Bank of Japan ran into the zero bound on interest rates and has been stuck there almost all the time since then, and that's meant that it hasn't been able to reduce unemployment back to levels before 1990. Okay. So again, you know, I want to stress a very simple conclusion that if there's a recession and that pushes unemployment up, that again, contrary to textbook economics, there do not seem to be strong equilibrating forces in the economy which say that unemployment automatically goes back down to the natural rate after a recession. That unemployment only goes back down after a recession if something affirmative is done to push unemployment down by the central bank. And again, that might not happen for various different reasons. Now, obviously what I've given is a very sort of reduced form empirical exercise looking at what happened to unemployment in different historical episodes. It's natural to ask, and many people have asked, well, what's the mechanism at work here? Again, I think theoretically, textbook models have good stories in which monetary policy matters because of nominal price stickiness, and nominal price stickiness doesn't last forever, so eventually monetary policy should be neutral. I think one reason why, if you're an orthodox economist who would like to ignore hysteresis, or think that that's a bother or politically incorrect, a factor that makes it relatively easy to ignore is that we don't have very good theoretical stories for hysteresis. So you're all familiar with the idea that maybe if workers are unemployed, that reduces their human capital or leaves scars. There are stories about, which I won't go into in detail, about how the normal Phillips curve can break down if there's a lot of long-term unemployment. But I think these explanations for why demand shifts or monetary policy can have very persistent effects on unemployment are, I think, very loose and casual. And I think there'd be a more compelling case that people need to believe in hysteresis effects if we had a strong explanation for the mechanism to go along with what I think is strong macro evidence that there's some kind of hysteresis effect for some reason. Okay, so I think I'm doing okay on time. I have 5 or 10 minutes left.
Yeah, 10.
Yeah. Okay. Okay. Yeah. So that's fine. Okay. Okay, so I'm currently doing a research project, which I hope will be done by the time the conference volume is published. Some of the results I'll show you were sent to me by my research assistant this morning. So this is cutting-edge research, is the positive way to put it. So now, what I've done so far may be somewhat persuasive to some of you because you might be somewhat inclined not to believe orthodox theory. I think for somebody who is skeptical of the evidence that I've shown so far, it's obvious that I've selectively chosen historical episodes in certain countries which fit the story I want to tell. So I think I could fairly be charged, given what I've done so far, with choosing historical examples that fit the story I want to tell. So what I'm trying to do is something a little more systematic, where I'm not going to look at every single recession that's occurred. but I have a group of advanced and emerging economies where I look over the last 25 years, or since 1990, and I look at a group of recessions caused by one type of shock, which is fairly easy to identify, which is capital flight. And so far, my rough and ready measure of has a country experienced capital flight is if its current account rises by at least 5 percentage points of GDP. Typically, in an episode of capital flight, a country might go from a trade deficit to a trade surplus as capital flows shift and the current account also shifts. If there's a 5% change in annual data in 1 year, I say that's an episode of capital flight. Having identified a set of episodes, I then said I'm not going to look at these selectively. I'm going to look at all the episodes in which there is substantial capital flight and look at the patterns that emerge. So almost always, again, this is annual data. In a year when there is an episode of capital flight as measured this way, we see a substantial increase in unemployment. But then what I'm in the process of arguing is that if you look at what after the initial increase in unemployment, if you look at what happens to unemployment after that in the next several years, it's explained very well by what happens to the exchange rate. So some of these examples we've seen already, Korea and Argentina. Russia is another example where there was a financial crisis which led to a big fall in the exchange rate. And so I have here, this is Argentina again, where, and again, this is what came from my research assistant this morning, where the red line is the real exchange rate, and the year when it plummets is 2002, because the currency board collapsed at the very end of 2001. And again, you see associated with this capital flight and collapse in the exchange rate is a sharp rise in unemployment, but one which is quickly reversed. So the economy recovers very strongly. In contrast, if you look at episodes in which there was capital flight and unemployment went up, and there was not an adjustment of the exchange rate, then that's when we see unemployment stay high. So Bulgaria and Hong Kong were economies with currency boards, and they maintained their hard exchange rate pegs despite having massive capital flight shocks. Greece maintains its exchange rate peg of 1 Greek euro is equal to 1 German euro, despite capital flight recently. And those are examples of when unemployment rose and stayed high. Actually, my RA also sent me a graph for Bulgaria, but I think actually the curves are mislabeled, so I won't show it. I'll show it to people later if they want to see it with explaining how the curves are labeled. Also, by the way, there are some counterexamples. So Indonesia is a counterexample where in the Asian crisis of 1998, the exchange rate collapsed in Indonesia. Nonetheless, unemployment rose and then stayed very high or even continued to rise. So there's not an absolute one-for-one perfect correlation between what happens to exchange rates and what happens to unemployment when there's capital flight. But again, I'm in the process of trying to look at this systematically and argue that even though there isn't a perfect correlation, there's a very strong correlation that by and large, what happens to unemployment, whether an increase in unemployment is persistent or not persistent, depends on whether or not monetary policy allows the exchange rate to adjust. I think that is all. That's all I have to say. Thank you.